Howdy, friends. Steve DePaul with the Rose Realty team with this week's real estate vlog from North Texas. Before we get started, we ask you to go to YouTube and subscribe to our YouTube channel, Let's Do Real Estate Texas. There's no charge, but you will be alerted to updates and changes to our series Spotlight on Community, Focus on Small Business, and of course, our weekly real estate updates on North Texas. Thank you. Let's get started. This week's topic, first-time home buyer mortgage mistakes. Now, we've talked about a lot of these mortgage mistakes over the course of the last 2.5 years. They've been incorporated in first-time home buyer, closing information and how to find a mortgage and how to find a house and the process steps for buying a house. But this particular vlog is just centered on the mortgage mistakes that first-time home buyers make. And some of these I've seen experienced buyers make. So let's get into it. Finding a home before a mortgage. The first thing you ought to do, and we've said this a lot of times, first thing you ought to do is find the mortgage first. Talk to a mortgage lender first before you go out looking for a house. Two real main reasons, right? First of all, they'll tell you how much you can afford, okay? You don't want to be looking in the $600,000 range when you can afford, when you want to top out at $400,000, okay? So you don't want to be doing that. So that's sort of step number one. Step number two is if you look for the mortgage first, you can take your time, you can be chill about it, and you can find that mortgage that fits you, okay? There are a lot of different mortgages out there, right? There's a lot of different mortgage programs out there for first responders and first-time home buyers and teachers, et cetera, et cetera. But you can, if you look for the mortgage first, before you even step foot in a house, before you even, give me a call and ask me to help you find a house, if you look for the mortgage first, you can take your time about it. You can understand the ins and outs, and you can understand what it's end up going to costing you in terms of fees and closing costs and these kinds of things. So we don't want to make any hasty decisions. You don't want to go find a house and say, oh my goodness, I need to get a mortgage. I need to find a mortgage now, and then just the first one that somebody qualifies you for, you grab. When that could be extra fees and higher rates and all kinds of different stuff in there that could end up over the course of the mortgage, could end up costing you, tens of thousands of dollars. We don't want that, okay? So first of all, find the mortgage first, then we'll go look for a house. You got my word, we'll take our time, okay? Not comparing loans properly. What a lot of people do is they look at the rate and they don't look at the average percentage, annual percentage, okay? Because what some mortgage companies do is they'll roll in fees and they'll have to start out with a low introductory rate, and then they'll roll in fees, and by the time you're done, the rate and the fees and the monthly expense are higher than somebody else's. And then during the course of the 30 years of the mortgage or the loan, you end up paying more. So you've got to compare them to kind of apples to apples. Ask the mortgage lender or the mortgage company for the loan estimates, and it'll bang tell you here's what they charge as a rate, as a fee, as a closing cost, those kinds of things, right? And the mortgage lender will be able to help you understand what those things are. And then once you have that loan estimate, you can compare one loan for one company to another loan on another company. Falling for marketing gimmicks like advertising hooks, mortgage, like they'll pay for your mortgage insurance, or they'll pay for your closing costs. Some companies pay for closing costs. Some companies roll it in. So some companies don't pay will pay the closing costs just out of pocket just to get you in, because what they want to do is they want to collect the interest rates. And other companies will roll it into the mortgage. So they say, hey, there's no closing costs, but you're actually paying for them over the course of the loan. Now, of course, it's a lot cheaper that way, but at the end on a monthly basis. but at the end of the mortgage, you've ended up paying those off with interest. Okay, it ends up costing you more. Not budgeting properly. This is sort of this is an interesting topic because it requires a lot of looking into the future. You may want to call it. I remember when I was buying my first house. Around the time I was buying my first house, I had some friends, and they went out. They extended themselves, and they were called what they called house poor, which meant that they had a great house and they had in a great location. It was a fancy schmancy house. But the problem was when you took a look at their disposable income. In other words, the income that they were allowed to go out and buy dinner on a Friday night, they had none. Okay, so they couldn't travel and they couldn't enjoy dinners out and those kinds of things. And they were eating like ramen noodles, 4 times a day, all that kind of stuff, right? So you have to understand what your monthly debt to income is, and you have to scale back maybe to get some enjoyment in your life, and maybe to do some home improvements and travel. Okay, so you don't want to be at the point where your house is sucking every last dime from your budget, and that you don't get a chance to enjoy travel or enjoy a night out or enjoy a vacation, those kinds of things. And you got to understand, you got to look in the future and say, here's how we think we're going to spend the next 5 years. Okay, we want to travel to Europe, and we want to go out to dinner every night, and we want to buy a new car, and whatever. You don't want to be house poor and not be able to do those things because you're going to be miserable. Okay, not knowing how to read the paperwork. Now, the paperwork here is in a mortgage is fairly complicated, especially after the mortgage debacle of 2009, 2010. Okay, there's closing costs, there's loan estimates, which we talked about a couple minutes ago. There's the rate, there's the monthly payment, there's terms, there's total cost, and there's cash at closing, just to name a few. Okay, I'm not a mortgage expert. I can get you in contact with a mortgage expert though if you want. So what we want to do is talk to a lender, or talk to a mortgage lender, or talk to even a title company who can help explain a lot of these things to you so that you understand. Now, remember on point number 1, we're going to hunt for the mortgage first, okay, before we hunt for the house. Well, here's where this almost should come in second when you come down to it, is that what we need to then understand is what all of these things in the mortgage paperwork mean. Now, 99% of them are just you tying you to the loan so that you'll repay it. But what it pays to do is to sit down with a lender or a mortgage expert to have them explain to you page by page or line by line, if you're a kind of monk-like, sentence by sentence, what each one of these things mean. Again, I know a lot about mortgages, but I'm not a mortgage expert, and I would point you in the right direction if I didn't have the answer. I hope that was helpful. These are mistakes that, frankly, nobody should make, but I think first-time home buyers, as a group of individuals who've never done this before, often make, and we want to try to avoid that. So if you're at that stage where you're beginning to look for the first-time house, look for that mortgage first. Come to us. We'll put you in contact with the right mortgage people, and so that you end up not making that mistake. Next week, hints for first-time investors. Great topic, because we've been through this. We're investors. We're real estate investors ourselves, and so we've been through some of these things, and we understand we understand this topic fairly well. This is Steve DePoe for the Rose Realty team. I'm going to bounce.